All right, we're live. Cool, man. Well, Avery, I appreciate you taking the time to sit down with me, man. I know we've known each other for almost 10 years, which is kind of crazy. But that's one of the things I like about being able to connect with you guys is, just our how we sort of started similarly and kind of different paths, but wanted to bring you on. And I think it's an important time to educate the market and talk to investors about, especially when it comes to cash flow and rental properties in Tampa Bay, just the state of the market. So that's what I wanted to dive into today, which is usually like more having coffee, what we talk about anyways. But there's obviously a lot that's changed over the last, let's say 5 years in Tampa in general. Your sort of role has changed too with Franklin Street. And so you've kind of seen, different facets of it, but it's definitely a challenging market, but want to hear from your perspective on a few things today. And so wanted to give you a chance just to sort of introduce yourself and Franklin Street and what you guys are up to, and then we'll dive into some stuff from there.
Thank you. Yeah, I'm excited to be here and talking multifamily is what I do every day. I'm in my 10th year in the multifamily business and 10th year with Franklin Street. So, um, as you mentioned, kind of have evolved over that time and started working on the local private client, call it 6 to 30 unit type of communities, and now have grown and starting to do a lot more larger 100 plus unit communities throughout a wider geography of Central and Southwest Florida. So still touching every client segment of the multifamily space, and we're working on everything from 100-year-old wood frame properties to brand new luxury new construction. So we have a pretty good pulse on the market, and I think to your point, yeah, it's a great time to be talking about it. It's a little bit choppy out there, and so I think services are valued when they're needed, and they're certainly needed right now. So
Yeah, I mean, I haven't seen from our clients like a lot of people buying anything new, which is what we talked about and thought maybe we could sort of start from like investors that are looking for multifamily and maybe give us a little bit of context to like what kind of unit size do you guys usually take to market? Like what would be the smallest sort of thing that you guys would start with, or you think, hey, this is a real place where people should start? Like if someone's gonna be looking to buy multifamily properties and they want to do more than 5 units, um, is that something that's a good fit for you guys? And then let's talk through like the challenges of buyers in today's market for the
yep.
multifamily stuff.
Well, you bring up a good point, and it's 5 units and more. So that's kind of the line that delineates residential and commercial multifamily is 5 units or more. So if you're at 4 units or less, generally the financing and the whole marketplace is a little bit different. It's more residential. As you get into 5 plus units, uh, everything's going to be more commercial. I mean, the financing, the insurance, the way deals underwrite, the property management, really everything starts to just be a little bit of, you have to look at it through a different lens. So my team, we do everything. Probably our smallest deal in the past year has been a quad in downtown St. Petersburg.
Hmm.
We just sold another 2 quads adjacent in Hyde Park Village, right outside Hyde Park Village.
Yep.
So we cover the gamut, and we have a pretty good market share of this boutique space from 4 to 30 units. We have three
Yep.
agents on the team that really focus on that. And then we have a couple agents focusing on the larger deals, myself, like over 100 units. And those are generally value add, middle market, call it 15 to $50 million size. Then we have another team that actually focuses on the larger deals, but newer vintage. So core plus type opportunities that might be newer construction. So we are truly touching uh, all different types of investors at different points in their life cycle and their careers and in their profiles. So yeah, it's exciting and it's a good gig.
Yeah, man. And it's dude, I think like multifamily is a lot of people are always interested in it. Some people think they have to start in single family and go to multifamily, and that's really like why we really like the multifamily space for us on the management side. Um, but like I mentioned earlier, there's been like no real transactions that we've really seen lately where people are like, hey, we want you to manage on something that is being a new purchase compared to 4 or 5 years ago. What are you guys seeing from when buyers are coming in and they're wanting you guys to make offers? Like, what's some of the stuff maybe in due diligence that you're noticing that buyers are really having to pay attention to, or that you would advise a client that's looking at a deal that like maybe you have the listing on, or even if it's listed with another broker? Like, what are some of the kind of key points right now in the market to, from a buyer's perspective, to kind of make sure the deals work, and some extra stuff that they should be combing through to make sure if the deal is really going to pencil out, based on a pro forma?
I think there's two things there that you just touched on. I think the first is that there's less inquiries that you're getting for management services for acquisitions. And I want to touch on that and also touch on, what buyers are looking out for in those deals. But there has been, the past 3 years has been a significant drop in transaction activity across all multifamily, across the entire spectrum of multifamily. So the small deals, the large deals, really everything, mainly driven by higher interest rates. So the Fed started raising rates in March of 2022. That immediately slammed the brakes on our transaction business because real estate is a leveraged asset. You generally
Yeah.
purchase it with a lot of debt. And so when the cost of that debt goes up, that puts downward pressure on pricing. And people don't want to sell when their price is lower. They're going to wait out for better times. Coupling that with an insurance crisis that we saw in Florida, where we might have seen 100 to 200% increases in the cost of our insurance over the course of a couple of years, that put pressure on net operating incomes, which also drove
Yeah.
down pricing. And then we had a record level of new supply delivered. We had fantastic rent growth in 2020, 2021,
Yeah.
even early 2022. And so everyone and their mother became an apartment developer and built a project in Florida.
Yeah,
So we had a,
we
go
loved it
ahead.
because our management fee is tied to the percentage. We're like, yeah, dude, we're all everybody's floating along. Everyone's ships are rising. But
It was good
yeah,
times.
it was, dude. And like now it's like there's some softness, and I mean I know rates maybe dropped a little bit recently. So I don't know if the activity has kicked up for you guys on the interest rate side, but you know, do you have any rough rules of thumb, at least like on insurance cost, or even sort of potential tax costs that someone's writing? I know there's some tax estimators if a buyer's coming in looking, okay, trying to just assume some of the fixed costs. Like you guys, I think, have a multiple departments where you're maybe able to advise on insurance policies and stuff like that. But if someone's trying to just take a look at a deal, do you have some rough rules of thumb for, what they might be paying, expect to pay on taxes, or and from the insurance side, have you guys seen better insurance offerings?
Yes, thankfully. So this year is the first year where we're seeing meaningful decreases in insurance premiums, and that's with better coverage. So you might see your wind deductible, your hurricane deductible coming down, which is better coverage, and your premium is coming down anywhere from like 10 to 30%, which is
That's huge, man.
yeah, on a lot of these deals that are pretty skinny to begin with in today's environment, that makes a huge difference. On the interest rate side, yeah, I mean, this past year, so 2025 year to date, has been substantially better in terms of transaction activity than both 2023 and 2024 because we're finally in an easing cycle with interest rates. So I have a client that's doing a conventional Fannie Mae loan right now that's rate locking around 5%. And that's a 5-year loan, interest only the whole time. That's an amazing improvement over where we were the past 2 years.
Yeah.
And
Those
for
most of
them,
those are usually 30% down, like unless like they're gonna
this
put down more.
particular investor is prefers lower leverage. So I think for them,
Okay.
it's a 60% or 65% loan to value, which the lower the leverage the loan, the lower the interest rate is because it's less risky for that lender. So they're in like a certain tier
Yeah.
that's less risky. But yeah, in general, interest rates coming down is improving the market dramatically. Insurance pricing coming down is improving
Hmm.
dramatically. You asked about rules of thumb though. On insurance, I would say we're seeing generally like 1,000 to 1,500 per unit as a
Okay.
good per unit cost. And I'm speaking to a lot of B and C class value add properties. I think you would probably see sub 1,000 a door if you had something newer,
Yeah.
newer construction. And I would encourage you to get an indication. You don't necessarily get a quote, but you get an estimate from an insurance broker like Franklin Street on any deal. They can usually crank them out within 24, 48 hours.
Yeah.
And it's all driven by replacement cost and the rate. So if you have a 500 square foot all studio deal versus a 1,000 square foot all two bedroom deal, you can have the exact same rate, but the replacement cost is going to be double for the 1,000 square foot because they do it as a dollar per square foot number.
Gotcha.
So, your insurance cost per unit is going to be double. So
Yeah.
just, get an indication, kind of understand how that insurance market works with
Yeah.
replacement cost and rate.
When you
But
guys
that's a good
offer like
range.
a pro forma, are you usually showing like, sort of what the existing owner is paying for taxes, insurance, all that stuff, and then maybe, obviously you'll have proposed on like the rents and stuff, but from like an expense side, are you guys kind of saying, hey, we think you could get this, like maybe with us or just with another carrier, we actually think your insurance cost could be lower. Like, are you sort of giving them like if someone's looking at if you send me a pro forma an email and I'm looking at sort of what it could be if I'm the new buyer coming in, are you already showing sort of potential savings on some of that insurance stuff, or at least for that insurance and tax item, you're kind of just assuming what the current owner's paying? Like how are you kind of
Yeah,
presenting
so
that?
we'll generally have three sort of underwritings. One is the trailing numbers, but it has the trailing insurance and the trailing property taxes, and then we'll have a takeover column, which means that's what the property is currently producing in income, but with some adjustments to the expenses. So the big ones that you're mentioning there are taxes and insurance. In Florida, and this is done differently by state and sometimes even by county, but in Florida, non-homesteaded property, so investment property, is capped at 10% per year for the assessed value for property taxes. So your assessed value can't go up more than 10% per year unless there's a break in title. So when you sell that property,
Yeah.
it gets reassessed at the new price. And the rule of thumb there is 80% of the purchase price will be your new assessed value
Okay.
plus or minus. And there's certain appraisal companies that do studies by county and say, Pinellas County was 85% last year, and Hillsborough was 78% last year on average. But
Yeah.
that's a good rule of thumb. So that takeover column will take into account the adjustment in property taxes for the sale, which, by the way, property taxes, the trim notices come out in September. You usually pay, if you're paying early, in November, the actual bill. So they're assessing it based on January 1 of the prior year. So if you closed a deal, let's say today, which is October 17th of 2025, you wouldn't actually pay the reassessed property tax rate until November of 2026.
Gotcha.
But most buyers, most lenders are going to underwrite to an adjusted property tax number at
Yeah.
takeover. And same with insurance. It's great that, or it might not be great that the seller could be paying $2,000 per unit for insurance, but when you close on that property, you might have the ability to get better insurance for $1,000 per unit.
Yeah.
And so that's a real takeover, savings for that investor that generally gets incorporated into the
Yeah.
middle, takeover underwriting. And then we'll build out the pro forma, which I think you're alluding to, which includes the, business plan of renovating units and increasing the rents.
Yeah.
So
Where do you guys see with cap rates? And you could break it out by class if you wanted as well. But what's kind of like the wide range on what you guys are seeing for cap rates? And it could be, hey, we're listing at this cap rate, but we really think it's going to sell closer to this sort of expectation. But what's kind of just a range for investors to understand, like what opportunities are there from a cap rate perspective? If people are thinking, hey, I could just put my money in the bank and you know get 4 or 5% without all the risk of real estate, and of course they're not getting tax benefits and stuff. But when people are taking a look at the opportunity cost, like what they're doing with their money, like what's some of the stuff that you guys are seeing cap rate wise, and or what you're taking to market, or maybe stuff that you have listed today?
it's a great question. We're finally getting some transparency into cap rates now that there's been some trades happening, some sales throughout 2025. So we have that price discovery now. And what we're finding is that it's probably the widest cap rate range we've had in maybe 7+ years.
Oh
So
wow.
yeah, everything's repriced, and there is now a difference between an A, a B, a C, and let's call it a D class asset. Um, because they do exist.
Yeah.
Uh,
And I
and
always, it's always a challenge when investors are like, yeah, I'm buying in this area and I'm gonna be making these crazy returns. And I'm like, dude, I don't know. It's like with anything. We typically, I mean, from our perspective, it's like we'd rather push investors to a better asset, sort of better area. I think long term actually achieves what they want, even though on paper, like sometimes the appearance of something on a higher return doesn't always shake out shake out that way.
sure, and that's why you need to conservatively underwrite as well, because those C and D class properties, not only do they require a higher cap rate, but they require a different padding on the expense assumptions for
Hmm.
things like capex and repairs and maintenance and turnover. They just run more expensively, so you need both to really feel secure. Um, but to that point, if everything was a 5 cap, then sure, of course you want to go to the good location over the bad location.
Right.
But the market is efficient over time. It's very inefficient in short-term intervals, but over long term, it's very efficient. And so there should be a premium in terms of the yield that you get for going into a lower income neighborhood. Now it's as simple as that, or an older
Yeah.
vintage property, or a tertiary market, right? So I would say, you asked about the range. I think the range right now is anywhere from a 5 cap to a 7 cap.
Okay.
And the A class deals are trading more towards the 5 cap
Yeah.
range. The B class deals are anywhere from like around a 5.5, probably to 5.75 ish. The C class is trading around 5.75 to a 6.25 cap, and then the D class is 6.25 to 7. And the D class can encompass some. It doesn't always have to be the asset. It can be a market that's really struggling.
Yeah.
So that might be a good segue just to talk about the different markets and submarkets throughout the territory that I cover right now. We're seeing like a crazy difference in what's happening in Pinellas County versus what's happening in which is St. Petersburg,
Yeah.
Clearwater, versus what's happening down in Fort Myers. There's just a huge glut of new supply that's hit Fort Myers, and operations are really suffering. Rents are
Mm.
going backwards. People are offering 2, 3 months free of rent, which every month free is like an 8% drop in rent. So
Yeah.
that's crazy.
Yeah.
Um,
Sometimes I saw somebody post something recently where they're like doing a value add, and and they're like, yeah, we're still getting these great rents increasing, and and this one specifically is in Tampa, and I'm like, I don't know, those rents seem a little bit high, or I'm like, they didn't make it apparent, but I could pretty much tell that they were probably just offering some crazy incentives, which is fine. Like, you benefit is you can still keep that rent roll looking good from a rental perspective, and if you're turning it around in a few years, like, you're sort of the one taking the hit on the front end, of like in that within that 12-month period of like free, 2 months off or whatever it is, and whatnot. But at least it keeps some of the paperwork on a higher rent schedule. But that's what kind of one thing that I'll tell investors like that are looking in the areas. Of course, we want people to invest in Tampa Bay, but it may not always be the right time. So, like, if there's other markets that you have experience in, or somebody grew up in, or if you have the operational sort of skills, or know you've been in the industry for a little bit, like, and you're educated on what it takes to invest right and stuff, you can always look at going into other markets, or just knowing that if you're like, hey, I really want to be here, maybe it's not the right time, or you just have to wait a little bit longer for that perfect deal to sort of come around.
well, yeah, I think the big lesson too of this cycle is the importance that we should all have on supply, and particularly like the importance of markets that have natural barriers to entry to creating new supply. So I love bringing up Pinellas County as an example because it's the most densely populated county in the state of Florida, and it's on an island. I mean, it's a peninsula. There's water on 3 sides. So there's no land anymore to build. You have to buy an existing asset and redevelop it into apartments for the most part. Whereas the farther you get out from the infill city center, you drive 30, 45 minutes out to Pasco County, there's nothing but land. and
Yeah.
they're getting severely oversupplied. In the short term, they'll absorb it. There's good growth, and they'll get through it. But that just can't happen in a Pinellas County because of those natural barriers to entry. And it's the
Yeah.
same thing in places like historic Hyde Park, which I know you manage in.
Yeah.
Um,
When
you know,
there's new supply coming on, like let's say it's a the entry point for that complex is like $2,000 for a one bed, and they're throwing incentives. Is that pulling up the resident that normally is going to pay 1,800, but they're willing to go up to 2 grand because they're getting a couple months free? There's maybe some extra amenities, or is it, or are people downsizing from that 2,300 unit maybe 10 minutes away down into the 2 grand plus the incentives? Like, as if I'm an investor and there's new supply coming on, how should I think about like whether that's really going to impact me if people are sort of moving up into those assets away from, like, they're moving out of mine, they're not giving me a non-renewal and moving up into a higher price back, or are they sort of non-renewing and coming into like a cheaper unit?
I think the general thought is that people move up an asset class in these higher supplied markets where there's a lot of concessions, right? So the B class tenant is now moving to the A class property. The C plus tenant is moving to the B minus property. And so it creates a trickle down effect. I certainly think that there could be some people that move the other way as well.
Mm-hmm.
But for the most part, it's a trickle down because people are moving up an asset class. They're getting a slightly nicer apartment for maybe the same price as where they
Right.
currently live.
Yeah.
And what's really challenging about that then is that that property that's losing a tenant now is actually struggling to release that apartment at the same rate.
Yeah.
So
Yeah. I'm glad we're
we're
getting here,
seeing,
because this is like something that we're dealing with or just seeing on some properties is just that, like the rent increases over the last few years had gotten it to a point where maybe it's now even a little bit above market, where new unit is going to rent for less. So how do you guys think about that when you're talking to a buyer or seller, and or just talking with investors? It's like, hey, like, how do you factor that in on paper, on like, hey, or I think we talked recently, there was a term or a report that you referenced that's sort of talks about that discrepancy of new leases maybe not being as high as the current market or current rent roll on the property.
yep, the lease trade out report has been a common request that buyers are asking for when we have deals on the market today. And it shows you for the leases that have renewed versus the new leases being signed after a move out, what's happening. And oftentimes what we're seeing is owners are willing to accept basically flat renewals or maybe a very slight increase because on a new lease they're getting a negative trade out. The previous tenant was paying
Mm-hmm.
1,200, the new tenant's paying 1,100, 1,150, right? So, and by the way, the tenants that live at the building, if they're savvy enough, they can go online and see that you're
Dude,
you're marketing.
that's the
Uh,
worst, dude.
yeah,
I'm like,
and
dude, don't
that
look online. Like, I don't want you to know.
that
Because yeah,
causes
dude,
problems.
bro, it really can. Like, it really could be a problem. It's a real challenge that we've seen on a few of ours, is that same thing happening.
So
And
I
so
think that whole concept of just market softness, though, it's out of our control.
yeah,
There was supply built. We're dealing with it. We're going to get through it. We've had record levels of absorption in pretty much all of the markets that we're covering in Florida. So that's great, right? It's a short-term kind of hangover that's happening,
yeah,
but it's created this microscope on operations, and basically everyone is becoming an asset manager and really looking deep at their P&Ls and
yeah,
how can I squeeze a little bit of extra income here? How can I lower in expenses through my contracts or whatever it might be?
yeah,
And and that's been the name of the game for probably 2 years now
yeah.
is asset management.
Yeah, I'm thinking like maybe, I don't know. Hopefully, rents will. I think they're sort of stabilizing, but I think maybe middle of next year might start to really get a little bit better. Are you guys? How are you guys thinking about rent growth or decline from a pro forma standpoint? So you have a seller that wants to come to market and is like, hey, I want you to pencil in, 2%, 3% on rent growth, make it look real sexy. How are you guys thinking about that expectation? Because a lot of you guys will do, you're sort of controlling both sides. Like you're listing the deal, a lot of times you're representing the buyer, working with the buyer direct. So how do you sort of have that transparency on like painting the real picture of what to expect on like, hey, they actually might be flat for the next, I don't know, year or something at least, and of course every buyer might look at it a little bit different, but how are you kind of trying to stay conservative on expectation of a new buyer coming in, and hey, it's not going to be 5% probably, right, for like the next 5 years consecutively. How do you guys kind of think through that and sort of provide um, details on for the investors that are kind of thinking about what should the rent growth be like, at least here in Tampa Bay kind of market?
Well, I think at a macro level, and that's a great question, but at a macro level, you just have to have a longer horizon, longer hold period than you used to. You used to be able to get in and out really quickly and have like an 18, 24, 36-month hold. And with the rent growth projections, everything works great. Well, that's not really what real estate is designed to be on the long term. There's pockets of that kind of
Yeah,
market frothiness that you can take advantage of. But on a 5 to 7 year horizon, which is the typical hold period for a real estate investment, in my opinion, uh, I think generally people believe in the growth of Tampa Bay and the rent growth rebounding because there hasn't been a whole lot of new shovels put in the ground for construction over the past couple of years. You're
right.
seeing some really trophy properties being built in like the urban infill locations, but not much else. So we're
Yeah,
actually going to be very quickly undersupplied from a housing perspective because we've still got population growth. And on that 5 to 7 year horizon, that's the type of buyer that's going to be active today is going to have that mindset. So that kind of solves for itself. And of course, every deal is different. Like that was the macro level. Let's
yeah,
talk about the micro level. If there's a property that is in an infill A-class location catering to a high income tenant and they don't have washer dryers in unit, well, that's a miss. And there is a
yeah,
disconnect where there might be a 5%, might be a 10% opportunity to raise rents just through a value add program installing washer dryers or smart
right.
home technology or new finishes. So there are still opportunities, value add opportunities out there that have kind of been overlooked by the
Yeah,
current owners.
that's been something that we've been focusing more on the last year or two, is just what's kind of like the minimum product, because if the rent growth has been sort of flat or softening in some areas where you have the new tenants not renting for as much as maybe some of the renewal tenants that are in the property, just trying to like err on the side of caution of how much we really want to invest in these units to get because you're not really getting the trade-off per se, and maybe the rent price. Obviously, a nicer unit is going to rent quicker than one that's not. But it's been sort of a challenge to kind of work through, you know, educating just the clients on like, this is kind of where the market's at. And I mean, most of them are happy to not spend as much money on turning a unit, but it's definitely something that we're having to think a lot through and testing. If we're coming in on a new deal, it's sort of testing the market on the first one or two, maybe doing a little extra upgrades, or just going in with almost like a bare bones unit and just seeing where's the floor at right now and kind of going from there. And so it's kind of a challenging market right now from that perspective too, on just making sure that hey, this is like kind of what we're penciling for, what we think we can get on the rents, um, but just not trying to over improve, the properties, and just kind of go out with a minimum product. And like you said, maybe offering some incentives on some of the multifamily stuff to help just get some people in the door, especially right now. We're towards the end of the year, toughest leasing market, seasonality wise. And so I wouldn't be surprised if people uptick on some of the incentives just through the year to kind of get some extra people in and get some leases locked in.
Yeah, I think it's amazing how much our industry has had to adapt. I mean, it feels like a short time. I guess it's been like 4 years since late 2021 now, which was the peak of our market, right? But it does feel like somewhat of a short time and how much we've adapted. Owners were forcing vacancy, doing their best to force vacancy so that they could get that tenant out, renovate the unit, and get a $400 rent bump,
Yeah,
right? And now it couldn't be more opposite. I mean, retention is the name of the game. The cost of vacancy and the cost of turnover to get that unit rent ready again, to go out and lease the unit for $50 less than you had before. I
yeah,
mean, the formula has completely changed. So it just shows how fluid the market is and how people like you, the boots on the ground, have to constantly be polling
yeah.
and staying on
Yeah, and
top
it's
of
a
the
great,
pulse.
just like you mentioned earlier, like the washer dryer hookup, such an easy but great improvement. But it's also that the sort of discussion around like, hey, we want you to put in 3 to 5 grand on this improvement. That's like you're not really going to get the sort of the trade off, maybe in like the total rent amount, but of course it's like just going to help you rent a little bit quicker than some of the competition. And having owners that kind of understand that perspective on like, I know there's some softness and we want to add an amenity still where we're not really seeing the trade off today, but like you mentioned, if the outlook is good, proper, sort of couple years, or hey, maybe year two of making this $10,000 investment is going to pay off on, some outside amenities or just something in the unit. Um, at least getting it done while the unit's vacant. But yeah, that's something that we had too, is people just didn't really care if the tenant would stay or not based on the
Well,
renewals that we were trying to get. And
like taking that example specifically, the return on investment formula used to be like, okay, it costs $1,500 to install this washer dryer, and I'm throwing out a number that's probably a little
yeah,
low, right? Um, you know, if I can get an extra $100 a month, then over 15 months, I get my return on investment, right?
yeah,
Now it's like it's $1,500 to install a washer dryer. We're charging $1,500 a month in rent. If we get this lease 30 days faster because it has the washer dryer, it's already returned its
yeah,
entire investment, right?
yep,
Within a month. So I think the way people are thinking about the ROI of these improvements has to shift a little bit,
yeah,
because before there was a $0 factor assigned to vacancy, and now it's a real, it's a real part of the equation.
yeah. I mean, we were just I was in San Diego at that Appfolio conference, and um, just one of the presentations was, obviously like around market data and renters and the whole leasing perspective. And I think in a lot of markets, it's over 45 days, vacancy, from sort of total, well, not even in my opinion, you're not even counting the turnover process in that, right? So like speed of maintenance, or if you're renovating the unit, right? We're just talking about literally days on market, where for I think so long we were sub 30s or right around 30 day, um and we're better than that sort of average, but still that's like when you're factoring vacancy loss, it's quite a bit different now than it was a few years ago, and just time on market. And then you also have the softness of the rents, and then maybe you're also having to increase the incentives, to get somebody even sign a lease. So yeah, the days on market's really tough right now, vacant
I think
units.
another piece, and this is all kind of on that concept of asset management. We're looking at every piece of the P&L, the rents, the other income that we can drive, and a big one that we're focused on now right now is economic loss, which includes vacancy, and another thing it includes is bad debt.
Oh,
And
right, yeah,
I'm curious as a manager what you guys are seeing, but anecdotally, all of the owners that we're talking to have seen an uptick in delinquency that they're starting to have to pay attention to. We're seeing
yeah,
like two, three, sometimes even in some markets up to 5% delinquency from these
yeah,
workforce housing tenants.
yeah, yeah. There's I think so right now we're around 300 units. We actually don't have any evictions right now, which is great. But usually it's like a one. I don't think it's gotten over maybe 1% rule, and of course it depends on maybe, sort of class of asset that somebody's managing. On that being a little bit higher if you're in, a CD thing, um, but overall it's not been too bad. But I think that you have some people. I think the delinquencies have upticked a little bit, and that's where, like from a management perspective, we're having to put more effort now than a long time on leasing, right? Leasing units, just whether it's like follow up or whatever. But the man effort to get people to, like, conversions, I think are actually a little bit better. Even the lead volumes down for new applications and showings and stuff. But I feel like we're having to do more effort just to really over communicate or just follow up with people on renting units. But also the same thing from the collection standpoint as we put in extra technology. We just hired another person recently that, like, one of their core focuses is just doing more of that. Even though it's like your softwares will do it automatically, right? There's just more effort having to be paid attention to follow up on collections and keeping just faster records, more updated records. And we're at a size where like we can sort of do that. if a residence like needs this little payment plan or something that we need to work on, and just trying to keep people in there. And really, like, we really try not to evict unless it's like absolutely necessary. So is the tenant communicating? Are they not? Are, when was the last payment? How much was it for? So it's maybe something that could be hard to scale at somebody managing 2,000 units to sort of have that much staff to get sort of that intricate with the residents. And of course, you're trying to provide a standard, it's sort of a standard process, but just that sort of communication piece, is really important for the owners to decide, like, do we really need to get this person out or not? And but just a lot more effort to keep on people just trying to keep the thumb and not letting get too out of control, and too high, especially on one single property. But I think for the most part, it's not been too bad. But there's some properties that you come in and you're sort of having to clean up some stuff. But it's just taking a lot more effort, which isn't really on the owner. It's on us as a management company. But yeah, just more effort to kind of get the same results we were looking for before. So it's just something we're having to
Well,
pay
and
attention to.
and the amount of attention that you guys have on it is, I would say, I can echo that from an investment sales broker standpoint. Buyers are asking for delinquency reports and aged receivables reports that they didn't used to ask for 4 years ago. It was a non-issue almost, right?
Yeah.
Um,
Well, we'll
they
just
might
kick them
have.
out if they're not paying. We'll just kick them out. You're like, oh well.
It was the type of thing that would be buried in a list of due diligence items that were required, but it would get thrown in a Dropbox folder, and then no one would ever pay attention to it
Yeah,
because
because
it
let's say
wasn't a
you have a
problem.
unit that the tenant's been in there for a while, and you're like, man, we're gonna have to sink 20 grand into this. Like, this is a heavy turn, or even 10 grand. And it's like, an investor may be okay with a resident sort of holding a three to $700 rolling balance if they're sort of showing progress, and they're kind of behind, or they get caught up, or they may be a little bit more lenient right now, because if it goes vacant, then you're just stuck with a big renovation to barely get market rates again, right? So there's a few select investors, that we have too, that would be just, hey, if we can just keep on them, and they're sort of still paying, at least. So some of it could be market driven, but some of it could be time of year. Like, man, we really don't want a vacancy right now. Like, if they could just sort of get them to keep paying something over the next 3 months and push us into January, February, then maybe we kick them out or something, or just non-renew when their lease is up. So that the strategy piece of it is pretty important. And of course, each investor is slightly different on how they want to do things, even though there's like a standard process around property management. Um, just trying to sort of cater to each individual investor on multifamily stuff to sort of execute the plan that they have. And if it's, it's a little bit easier sometimes if it's just them. But if you have a capital group or somebody raising capital, then it's good for us to know that they're having outside pressure on expectations of performance from limited partners or just other business partners, that you have to kind of just know, as part of the conversation as well. What are you guys seeing for, like, people taking properties to market, like from the seller side, of where you're advising them to either make certain improvements or just think about that, like, matters more today to the buyer than it used to, or you know walking them through the listing process, setting expectations on repairs, or if it's a certain age of building, things that you guys are like, this is a little bit more important now than it used to be.
We have formalized our pre-listing process a little bit more than we had in the past. So buyers are scrutinizing the deals we have on the market, and they're asking all the right questions, and they're expecting transparency. For example, like to your point about stipulations with tenants that are behind on rent, they want to know. They want to see the 30-day age receivable. What's 60 days delinquent? What's 90 plus days delinquent? And I want to know the story with every tenant.
Yeah.
They're asking if it's an older vintage property, call it 40 plus years old. They're asking about plumbing. What's been replaced? Has it been lined? Has it been jetted? What's the condition of the roof? And they're expecting to get detailed responses on all of those things to make an educated and kind of conservative estimate on capex dollars that need to be
Yeah.
spent.
If you have somebody going to market, is that, I know we talked about like jetting some of the plumbing lines, or maybe even just getting some proactive, like camera recordings to provide a buyer. Like, what's some of the stuff if someone's thinking about taking a property to market that they may want to do proactively, just to get that property a little bit better ready, whether it's curb appeal related or just something on the financials that's going to sort of give you guys, and then like the best foot forward from listing price perspective.
So, in my opinion, the best thing you can do to prep a property for market that's a value add deal is the things that don't generate you more rent. For example, like jetting the sewer lines for these 1960s, 70s built communities, they have a lot of cast iron sewer lines, and the horizontals are a problem. They are past their 40-year useful life. People are going to probably camera them during a due diligence. And if they haven't been jetted in a long time, they're going to look disgusting. It's very easy and relatively inexpensive to jet those lines. And when you jet them, you're just basically, it's a tool to pressure wash the interior of the line because it corrodes from the inside. And they will look beautiful after you jet those lines, assuming there's no like major actual, breaks or anything.
Yeah.
And when that buyer goes to camera it, they're going to see a clean line and get a clean bill of health. It's the exact same pipe that was there before you jetted it that would have caused a problem. So
Yeah.
I highly advise people to jet cast iron horizontal sewer lines before listing a property. Just like the reward is great and the downside or the risk, the dollars is low. Another thing we're seeing is flat roofs are very expensive
Mm.
to replace. Oftentimes, if it's like a TPO product, you can do a silicone overlay on that roof for relatively inexpensive compared to a full replacement. And that silicone overlay has a 15-year warranted useful life.
Yeah.
So,
Have you seen some of the insurance companies get more strict on what they feel is a useful life? Like, I know on the residential side, sort of roofs aren't looked at like they're wanting them replaced at an earlier life than they used to. But do you guys see any of that on the multifamily space or not too much?
the insurance market is changing so much that we were seeing that, and now it's already changed.
Gotcha.
There's capacity back in the insurance market. They're aggressively trying to build their market share and build their book of business
Yeah.
again, and so it's not
Yeah.
as important.
No, that's good because I know yeah, some of our clients in multifamily space, like you mentioned, had insurance costs go down, which I was like shocked. That was
Yeah.
even a thing. Um,
If you didn't have your insurance costs go down this year, then call Franklin Street immediately.
Got to
Because yeah,
shop it around.
you should be seeing better coverage and lower premiums in 2025 compared to the previous year.
What do you
But
think is
so
gonna
I
be
want to touch
trending?
on
Yeah, go ahead.
one more thing with the pre-marketing fixes because I think it's important. If it's a value add deal, oftentimes we won't recommend you to make it look better before marketing. The curb
Mm,
appeal, like if it's an ugly paint color with bad landscaping, that helps the brokers sell the pitch to a new buyer
gotcha.
of look how easy it is. Yeah, they're getting the rents they're getting today because the property looks like this. So
Yeah.
all you need is a modern paint scheme. You plant some palm trees and some hedges and do some landscaping, and you'll be able to increase the curb appeal quickly and raise the rents.
Yeah. No,
So
that's a good perspective. I hadn't thought about that part as much as I have heard some people like, if you got 20 units, you still, maybe keep a couple of them unremodeled or, not rents low on purpose, but like you want to leave a little bit of or the appearance of a little bit of, sort of just upside for new investor coming in, make some changes. So that does make
yeah,
sense.
specifically, I often don't recommend people. A lot of people ask if they should paint the building before they sell it, and I often don't recommend that because people have such unique, you know, emotional connections to paint specifically and like a color that they really like that it's better to
Yeah.
just let someone do that themselves. So we have some opportunities right now that we've advised them not to do anything before we take it to
Gotcha.
market.
Well, that's a good perspective. What do you guys think is going to be sort of 2026 feel? So I feel like 2024 for us was kind of like slow and just opportunities. This year's been vastly different. A lot more owners calling us for new management, whether it's like, you know, maybe it's buying something, but more so even on single family, like people moving out and just moving around and stuff. But just like people not satisfied with their management company, just leads in general, right? Just activity of people buying, whether it's, and we didn't even dive into like a lot of calls we got were like short-term rental investors that were flipping to long-term rental unfurnished, or maybe even trying long-term furnished because the short-term rental market wasn't working. But what do you think the outlook is for next year compared to this year? Um, I think it's going to be should be better even than this year, but especially if rates come down, that's like a big driver. But like, what's your kind of overall sentiment within Franklin Street that you guys have seen for this year? How productive has it been? And what are you guys kind of expecting to see next year a little bit?
Yeah, I think we have the bottom is already behind us. We are on the way back up in terms of values, transaction activity, just a more healthy market. We've been in a really unhealthy market for a few years where I think transaction volume for what I focus on plummeted like 90%.
Yeah.
So, and we felt that in our pipelines as well. This year, we've seen a strong rebound. I think as rates continue to come down, the Fed continues easing, as insurance pricing continues to soften, as the wave of new supply has continues to get absorbed and there's not much behind it, it's a great formula for the future. So I don't know exactly when that's going to happen. I think there's a lot of people hoping that it's Q1, Q2 of
Yeah.
2026. And so I'm expecting a large amount of activity, a lot
Yeah.
of deals coming to
The other thing
market.
is like those fixed costs are changing, right? Like the competitiveness around the insurance and the interest rates is like just some of those things that you just get stuck with whatever the market's sort of dictating. And that's what's been challenge for us too, is like owners coming in and with them in the past getting the squeeze on all those things. The only other thing to look at is like management fees or whatever, or like maintenance costs, like just some of this other stuff that you're really having to dial in on. Whereas like that stuff from an underwriting standpoint controls so much of the conversation of if people are even interested in making offers or selling this older property and wanting to upgrade into like either 1031 or just getting into a better property in a better area. So much of it's driven by interest rates, first and foremost, but also insurance and stuff.
Yeah, I do think it's interesting that like, in an increasing market, there's always someone that bought 3 years ago that can make a good profit, and someone that wants to buy now and sell in a few years and make a good profit, right? And that like kind of linear upward track. Well, we've been all over the map, up and down, all around for a while now.
Yeah.
Uh, I think what's going to happen is these late 2021 era deals that were kind of at the peak of the market, oftentimes financed with floating rate bridge debt, those are going to come to a resolution. They matured last year. Most of those bridge loans were 3-year deals. So late
Yeah.
2021, it matured late 2024. They got an extension to late 2025. Well, the lenders aren't going to play ball forever. They're starting to resolve those. But what I think is actually going to be a lot of the market activity is these owners that bought between, call it 2018, 2019, maybe
Yeah.
2017 to 2019, that would have loved to have sold in 2023, 2024. They had planned for it, but they didn't have a need. They have profit built up in that deal. They have
Yeah.
equity that is trapped, and so I think that those are the types of groups that are going to execute the second the market shows signs of life and rebounding.
Yeah.
So that's what I think is going to happen in 26. Is a lot of those longer term, call it 5+ year owners, are going to
Yeah.
execute sales.
Do you think some of the sellers have like sort of come to a realization on like expectations for their listing price? Because I know at least for sure, like 2023 and stuff, there was just like sellers had not mentally gotten with the program that like this was where the market was. Like, do you feel like that's pretty much like people that are coming are much more open to, because rates had just been so sticky, like kind of just coming to realization of what the market and the buyers are willing to pay?
Yeah, I think more of them have. I mean, some of them have, and maybe even it's fair to say that most of them have. And by the way, you can't really blame a seller because there was no data to show them what pricing really was. There were no trades
Mm,
happening. So how can you, admit this negative result and believe this bad result for yourself where there's no evidence to support it other than what people are telling you? But
yeah.
now we've had some trades happen in 25. We've got some price discovery. So most people are coming around to the reality. And by the way, it's been over 3 years. So
Yeah. Yeah. I
you've
know.
got to be pretty stubborn to not come around after that amount of time.
Yeah.
Yeah, no, I feel like it'll be a robust market in 26 and beyond. And, multifamily is not going anywhere. Central Florida's, not going anywhere. It's continuing to be an awesome growth market. And Tampa is like the shining star of it, in my
Yeah.
opinion.
Yeah. I'm always excited about new stuff that's coming to sort of into development or finally breaking ground that we've been hearing about. And so maybe one of the last things I wanted to touch on was from a financing perspective. Is stuff really relatively still the same as like what the average buyer is coming to the table with for down payment for sort of like term of loans? You mentioned the interest only period on a deal earlier. Like, is all maybe just cover some of the basics of like what the average deal might look like from a buyer's sort of financing perspective, and if there's been any real changes. I guess the main thing is like a lot of people, or it may not even be available, is sort of that short-term bridge debt. Like, you know, wouldn't make sense to really do today, so I don't think that's probably a big piece of it. But maybe just talk through sort of some basic financing that you're seeing, and that would be pretty common for a standard deal.
Yep. It's a good point. So we've actually been able to be a part of transactions that included bank, credit union, bridge, government agency, Fannie Freddie, all this year. So we've kind of got a good understanding of where they're all at. And I think what I can say is that the LTVs have gone up relative to the limited transaction activity in 23 and 24. And a big part of that is that pricing has come down. So the lender isn't necessarily, LTV is just one of their levers that they use to control their risk.
Yeah.
They're really focused on the debt service coverage ratio. So the net operating income that this property is producing needs to be able to cover the debt and then some, because that makes them feel secure. So the minimum DSCR is 1.25. You got to cover your loan, your debt payment, and then you got to have 25% more as a cushion so the lender feels safe.
Right.
And with where pricing has come to, their loan proceeds now are around 70 to 75% loan to value on a lot of these deals. So that's really great because in real estate, as long as you have positive leverage and people are buying deals that have positive leverage stories, you're making that, you're enhancing your return by using that debt. So where the lower down payment you can do, as long as you're making that positive leverage, is going to just enhance your returns even more. So I feel like that's been a welcome return, the high leverage debt for a lot of these buyers.
Yeah, no, that makes sense. Cool, man. Was there anything else you wanted to finish off with? But dude, it's been a great conversation. Always enjoy talking with you guys, and just it's something that I think obviously our investors like expect us to help them just navigate the market, right, and understand where are we at, what's coming, and so proactively communicating sort of the information that we talked about today is always, I think, an important thing that investors are looking for, on just boots on the ground, and then also like especially from the broker sales side, what you guys are seeing, because you're so much in the weeds when people want to obviously buy and sell, what's important, what's transacting. So it's all good
No, I
stuff, man.
think now is the time to be sharpening your sword. Now is the time to be tuning into things like this and understanding the market dynamics to really make a move, because you need to position yourself for this next cycle. And we're clearly coming off of a bottom, and we're about to go on another good ride here in Tampa Bay and Central Florida, and hopefully elsewhere in the country as well. So now's the time to be doing things and getting smart and positioning yourself correctly to capitalize.
Getting in on the action.
Yep.
Cool, man. So how
So
would if someone wants to get in touch with you, what's the best way to reach out?
you can reach out via email. You can call me on my cell phone. My email is avery.jordan@franklinst.com. Jeremy can
Sweet.
share my information, but I reach out to Jeremy and he'll send you my way.
Yeah. Text intro or whatever. Cool, man. Well, I appreciate your time today, dude. Always valuable insights, and we'll have to make it a recurring thing.